So we are currently almost done with the earnings season. However, as you guys can clearly see, there's still a lot of companies that still have earnings so far. And the one in particular that I really want to talk about today, it is the company Cisco, because this company has been through a whole lot in the past 2 decades, more than 2 decades now actually. And well, if we actually take a look at the graph on the max end, we can actually see that Cisco back in 2000, March 2000, right before the dot-com bubble popped, hit a price tag of around $77.31. Maybe even up to close to $80. And 25 years later, we have still yet to peak that level at all. In fact, as you guys just saw this, we're currently sitting at $71.75. So this is a company that has not recovered. And if you bought right here at this peak, you are still, aside from the dividends, you are still down overall if you bought majority of your shares right over here. So I really am wanting to take a look at this company to see if it's even worth the value in the next 10 years based off of their fundamentals. Now, let's actually take a look at this on the 1-year perspective, currently up 22.31%, hitting a low overall at around $53.19. On the year to date, we are up 21.27. To be more specifically, the 52-week low was $52.11 and the max of $74.84. Now, looking at sentiment between Seeking Alpha and Wall Street, we can see that Seeking Alpha has 12 authors in the last 30 days. 2 of them are saying a strong buy, 2 of them are saying a buy, 6 of them are saying a hold, and 2 of them are selling a sell for an overall hold rating of 3.33. Now, Wall Street, on the other hand, is actually a little bit more bullish than the company. Overall, 26 analysts, 11 saying a strong buy, 4 saying a buy, 10 saying a hold, 1 saying a sell, for an overall buy rating of 3.96. Now, obviously, they do have earnings coming up today. As you guys are seeing this, it probably just came out, honestly. We can see that they're actually fairly bullish. On the last 90 days, we got 16 total revisions, 14 to the upside, 2 to the downside. Overall, they're expecting a normalized EPS estimate of 98 cents, EPS gap of 70 cents, and a revenue of $14.78 billion. So let's actually see how this company even turns out when the earnings actually come up. Will it go up? Will it go down? If they say anything regarding AI, most likely this will continue to go up if they announce any partnerships or anything like that. Now, moving forward, let's actually take a look at the spreadsheet. Now, I'm going to do this a little bit different. Let me know if you guys prefer this format or the format that I normally do it in. But let's actually start it right now. We got the ticker, guys, for CSCO, market cap of $282.53 billion. I already showed you guys the overall share change, so no reason to take a look at that. We got a PE of 30.31, so a little bit expensive as opposed to what I normally like to buy that at around 20. However, tech company, I guess you could kind of justify it. Now, they actually do pay out a dividend, and it's currently sitting at 2.27%, with an annual payout of $1.64, payout ratio of 42.63, 5-year CAGR of 2.65%, so very, very small, 14 consecutive years of dividend payment. Ex-dividend date passed as of October 3rd, payout date was October 22nd, and they do pay their dividends quarterly. Now, if we actually take a look at the free cash flow in regards to this dividend, we can see that it is currently sitting at 47.29% when it comes to the payout ratio in regards to the free cash flow on the 10-year. Then, as of the last year, it is sitting at 48.87%. Price to free cash flow, this is another metric that tells us whether the company is expensive or not. We got 21.26 as of the current. However, the 10-year average is sitting at 14.35. So another metric that's telling us that this is looking a little bit expensive. Obviously, you want the 10-year to be higher than that of the current. Price to sales currently sitting at around 5 and net profit margins of 18%. Now, when it comes to the net income, we can see that's actually been flat, kind of, in fact, going down at around 5%, going from a total of $10.74 billion to today of $10.2 billion. Not necessarily liking that, especially for a tech company like this. When it comes to the free cash flow, again, flat, slightly up, but flat. We got $12.4 billion to today of $13.3 billion. increase of 7% with an average of $13.7 billion. When it comes to the revenue increasing, however, guys, tech company only increasing 15%, not really that impressive. Going from $49.25 billion to $56.7 billion. Looking now at the assets as a reference only, you can see it's basically flat, right? Going from 121 to 122.3. Basically flat in the past 10 years. Liabilities, on the other hand, they really ramped up their liabilities, especially as of 2023. Now, assets minus liabilities, there's a big decrease in 2017, and overall it's been kind of trending upward since 2018, but still not looking too hot. When looking at the average total assets, we get $110.5 billion, liabilities of $64.21 billion, a difference of $46.3 billion in the positive. Now, looking at the cash flow minus the liabilities, we can see that from 2017 to 2022, they were heading in the right direction. However, massive dip, especially in 2023, and now they're kind of crawling back up. Innovation, I guess you could say, AI, I guess you could say, sure, but I don't necessarily like this. Normally, I wouldn't mind it, but with this company, the fact that nothing really has been increasing, right? Things have just been kind of stagnant, slightly down, slightly up here and there, not necessarily liking it. And we can see that with the average being negative 50.5, again, it's not something that normally I would be okay with. However, with this, I'm not necessarily liking. Now, they are buying back a lot of shares. I mean, we got 5 billion shares 2015 to the trailing of 4 billion shares. That is a massive buyback of 21.26% on the 10-year. Previous year to the current year, buyback of 1.17. Loving this. Honestly, this is actually good. I don't see anything wrong with them buying back shares, seeing that they probably feel that their company is very, very undervalued. And honestly, I kind of agree with it in the sense, well, I guess in the sense in comparison to that of the dot-com bubble. Hasn't really recovered ever since, right? So I kind of understand where this is coming from. So I'll give them the benefit of the doubt. I do like this overall graph when it comes to the shares outstanding. And lastly, cash and equivalents. They currently hold $8.35 billion with an average of $9 billion. So with that said, let's actually go back into this format and take a look at the discounted free cash flow. And we can see that the revenue to free cash flow growth currently sitting at 26.39. Net income growth, 1,062. So this is actually a massive, massive outlier, because if we actually take a look at the overall increases when it comes to the net income growth, the reason why that's the case is because in 2017 we got $110 million in their net income, and in the following year we got all the way up to 11.6 billion, making this change, right, 10,464%. So I'm basically going to remove that from the pool because that is a massive, massive outlier. And doing so, we get at around 19% when it comes to this average net income growth. All right, so that's the reason why I am going to put my net income growth really, really low. And on top of that, what did we just see with the net income, guys? Minus, right? It's down like 5% overall in the past 10 years. I'm giving them the benefit of the doubt. I'm going to put all of mine in the positive, but very, very low. Very, very low. Average shares change, they've been buying back at around 2.32 every single year within the past 10 years. Now, if we actually take a look at these numbers, I'm going to say free cash flow to revenue growth, 20, 21, and 22%. Net income growth, 5, and again, this should be in the negative. 5, we got 6, and we got 7%. I'm going to say a PE of 15, 17, and 19, right under the cusp of what I normally like to buy it at. Share change of 1, 2, and 3%. And then a discount rate of 9, we got 8 and 7. And with this, we get target share prices of $100.81 to $177.03. Guys, by the looks of it, I mean, it's looking still very, very underpriced, as you guys can see right here, right? However, the company itself, when it comes to a fundamental perspective, it is very, very risky, right? I mean, the company in the past 10 years hasn't seen net income growth, right? The past 10 years has not seen net income growth. Free cash flow, slightly, very, very slightly. So really, really be careful with this one. You could say that, yes, it's looking very, very good in general when it comes to the discounted free cash flow, but the fundamentals are a little bit scary, if I do say so myself. Now, in regards to this dividend, if we actually say that we want to invest, let's just say $6,215, and the reason why I'm saying this is because this is the basically 1 month based off of the median U.S. income per year. Monthly would be $6,215. At the current annual dividends per share of $1.64, this would buy you 86.67 shares, which is an annual dividend of $142.14, monthly of $11.84. So when it comes to Cisco in general, guys, I gotta be honest, not my favorite, right? I mean, you have Nvidia, you got AVGO breaking records over here, amazing fundamentals. Microsoft, I mean, cybersecurity, I think Palo Alto, I think is a lot better than Cisco in general. But yeah, in general, guys. But overall, Cisco, not my favorite kind of company. I mean, 25 years and they still haven't recovered from the dot-com bubble. Yikes. That's something, all right? That's really, really something. So take that with a grain of salt. Not my favorite cup of tea here. But let me know what you guys think in the comment section below. Let me know also what you think of the format when covering the spreadsheet, except for the discounted free cash flow. I figured that this was a lot better. Just maybe you guys like it better. I don't know. We'll see, right? We'll see. But let me know in the comment section below. Do you like this company? Do you want to buy it? Do you hold it? What are you doing with this company so far? But anyways, that pretty much does it for this video. Make sure to subscribe, comment. Really does help her with the algorithm on YouTube as well as Rumble. Make sure to follow us on X at Fatal Investing. And of course, if you'd like to join us on Discord, the link to that is in the description below. So with that said, guys, peace out and have a blessed day.